Great. Thank you, everyone, for joining. This is an interesting topic that's hit the news a lot lately. The topic of special purpose acquisition corporations, or SPACs. I've heard about SPACs for a long time, but they're always sort of under the radar. But just over the past 5 to 6 years, they've just increased in popularity. If you look at sort of the nexus of SPACs, actually LA is over-indexed in SPACs. And part of the reason is the firm I used to work with, the Gores Group, has done 5 SPACs over the past sort of 6 to 7 years. And they recently did the largest SPAC ever. I think it was like a $13 billion acquisition. So LA is sort of a center of the SPAC universe. And we've pulled together a great panel of business people and attorneys to talk about their role in the SPAC ecosystem. We actually have 3 SPAC sponsors on the panel and 1 SPAC general corporate finance attorney. So with that, the structure of the discussion is going to be introductions of the panelists. I'm going to walk through a handful of specific questions. We're going to do a very brief introduction to what SPACs are, and then we'll have some Q&A at the end. But looking forward to an interesting discussion. So why don't we start with introductions? So on my Zoom camera, I'll just start from left to right, and I'll start with Warren Louie from Stanford.
Sure, and I think I'm off mute, right? So everybody can hear me?
Yeah.
Sure, I'm Warren Louie. I'm a class of '81 JD MBA. Unlike the 11 other, well, there were 12 of us JD MBAs, 10 went over to the business side, 2 stayed in the law. I was one of the 2 that stayed in the legal field. So I've been a lawyer for just about almost 40 years now. I'm at Winston & Strawn now. I've been at a couple firms beforehand, and I have a broad based practice. It's generally a corporate and a corporate finance practice. And in the last couple of years, the SPAC area has become a little bit more interesting for me. Right now, I've got 2 clients that are looking to be, are in conversations to be acquired by SPAC. And I've got 1 client who actually just today called me that wants to hire us to form their second SPAC. So it's been an interesting development over the past few years.
Great. John?
Hi, folks. John Huberman here. I'm the sole non-Stanford person. As I mentioned to the other panelists, I couldn't play football there, so I went to undergrad to Princeton, and then I got rejected in the business school, so I had to go to Wharton. But other than that, I've managed to do okay since then. The last 25 years, half of it in private equity, the other half running software companies, 6 different ones. I started my first SPAC about a year and a half ago. We de-SPAC'd last month, a company called Curiosity Stream, streaming media company. I raised another SPAC about 2 months ago, and we're actively seeking an acquisition target. And my company's called Software Acquisition Group, so sort of tells you what we're looking for. But I appreciate, and I'm looking forward to the questions.
Jamie?
Sure, I'm Jamie Mandola, GSP class of 2005. I spent most of my career in private equity and hedge funds, and I think formed the first SPAC dedicated fund back in 2015, before SPACs were cool. And after operating the hedge fund for several years and being active in the cannabis space, I joined a family office where we put together the first US-focused cannabis vehicle through a SPAC format, which we de-SPAC'd in the spring of 2019, which is now called Air Strategies and has performed very well. And we have a second SPAC platform also in the cannabis space where we've raised $400 million to focus on building the largest independent brand portfolio in the US cannabis sector.
Great, thank you. And then everyone who registered for this event, I believe, used Eventbrite. So Kevin, I think, is one of the founders of that, and he can talk about his background.
Thank you. Matt, always thrilled to hear that you used Eventbrite. I'm one of the co-founders of Eventbrite and operated. I was CEO of the business for about a decade. My wife took over and is doing a far better job than I could have done. And she's the CEO today. The company's out on the New York Stock Exchange. Before Eventbrite, I co-founded a company in the money remittance space, so helping immigrants send money back to their families all around the world. That company was called Xoom, Xoom. And that business went public on the NASDAQ in 2013 and was acquired in 2015 by PayPal. I enjoyed and learned a lot by angel investing alongside of building companies. Had the good fortune and luck to be an investor in PayPal, seed investor in PayPal, seed investor in Pinterest, seed investor in Airbnb, to name a few. And then in trying to figure out what's next for me, came across this phenomenon of the SPAC, and over the summer launched A-Star. A-Star is the parent vehicle, and our first SPAC is called One, and it's a $200 million SPAC. And thanks for having me.
Great, thank you. So we're going to start with Warren just giving us a couple slides. I don't want too many slides to slow down the discussion, but just a little bit of background on what a SPAC is and how they're raised. So I'm showing your slides, Warren.
Sure. Okay, thanks. Yeah, and I don't intend to sort of go through every bullet point. It is really just intended to be an overview, and hopefully for many of you, this is just sort of a little bit of a refresher course. But a SPAC, Special Purpose Acquisition Corporation, they've actually been around for a number of years. I was looking, and there were SPACs done back in the 1990s. One of the differences is that they tended to be for smaller companies and for more infrastructure and energy and telecommunications projects. But over the years, it's grown rapidly. Again, just a note, back in 2016, there were 13 SPACs done for $3.5 billion. Year to date, numbers I had through July, we had $65 billion raised and 181 SPACs. And our firm, I think I mentioned beforehand, we've got about 8 that we're working on right now. So it's really exploded. But again, what is a SPAC? It's basically a newly formed corporation with no operations. We used to call them blank check companies, where a company was formed and capital was raised, and it was essentially giving a blank check to the sponsors. But the theory is you raise capital in an IPO that will be used to complete an acquisition of a private company. Most importantly, I think, is that the target must not be identified at the time of the IPO. So these are companies that are formed, the capital is raised, the sponsors are basically being given the mandate to go out and find a company, and typically it would be a company. When you form that SPAC, you indicate the types of businesses that you would be interested in acquiring. It's sort of what we would call the de-SPAC process, which I think some of our panelists had already mentioned. The de-SPACing is basically the acquisition of that company. And maybe the next slide really quickly. So the SPAC conducts an IPO to raise capital. So that it is an IPO. The SPAC is raising the capital. The cash is raised, and I'm now going to the third point. The cash raised in the IPO is placed in a trust account and is not released until the SPAC completes the business combination or a specified outside date, typically 18 to 24 months. And so that means that the SPAC has essentially 2 years to complete an acquisition. One of the things that I think is kind of interesting right now is because there's been so much SPAC activity, one would infer that over the next 2 years, there's probably going to be quite a bit of M&A activity, and I'm sure the other panelists will talk about how that affects pricing and valuation. We've had at least one client that lost an opportunity to do a de-SPAC because the target was able to get a far more attractive offer, 50% of what the valuation was. But again, these entities, they raise the capital, you put the money into a trust account, and then they have essentially 2 years in order to find a company and basically merge with that company. So maybe I'll just stop there, and hopefully that gives you just a general sense of what the SPAC process is like, and we'll talk more about the pros and cons versus an IPO and other aspects of it later.
No, I think that's very helpful. So perhaps the panelists could talk a little about what types of companies they're looking for. And I know it tends to be, you can't define in advance, but the broad parameters of what you're looking for.
Well, I'll get started. It's pretty easy. I'm looking for so I have 172,500,000 in my SPAC. This cash and trust. I'm looking for a deal that is a software enabled that has an enterprise value in excess of 500 million, that wants less than 250 million of cash being delivered at close. And we can go into more detail on that, but it's a wide mandate. I'm looking at a deal right now that's a 2 billion EV enterprise value. I'm looking at one that's a $500 million enterprise value. There's reasons you can't go too small, which we'll probably get into, but I have a very wide mandate, and it enables me to actually pursue a lot more deal opportunities.
I also want to mention, because these are public companies, there's probably some things that the panelists can't talk to, so they may have to punt on some items, but you can talk to whatever you can. Jamie?
Sure. So we're on our second SPAC in the US cannabis space. We think it's a very interesting sector for SPACs, particularly because a lot of the institutional investors and VC and private equity funds and hedge funds have institutional restrictions that make it difficult for them to deploy capital into the space, given that it's still a federally illegal business, despite the fact that 35 or so states have either adult use or medical marijuana programs passed. And so in many respects, this is unique because there's not the ability to directly list on the NASDAQ or the New York Stock Exchange. We raised our SPAC vehicle up in Canada, where virtually all of the US cannabis companies are listed. And so we think it's a unique opportunity over the next couple of years where traditional sources of capital can't really play. And given the growth in this industry that probably looks very tech or software like, there's very little capital available to these companies at this point in time.
Great. And Kevin?
Yeah, thank you. We're a $200 million vehicle. So you generally look at companies that are kind of 4 to 6 times the size of the SPAC. So that puts us in the 800 to $1.2 billion range. However, one note is that we intentionally chose to be on the relatively smaller side of SPACs. I know it sounds strange that 200 million is small, but it is. In this era of the mega SPAC, because we can actually stretch up and complement the money with money from a PIPE, and that's a public investment in a private entity. And that PIPE money gives the partner company the opportunity to get some of the folks that currently don't participate in SPACs, like the Fidelities, the Bailey Giffords, the Wellingtons, all the kind of A-class names. So we designed ours for kind of maximum flexibility. A-Star, our parent vehicle, is a reference to a Stanford search algorithm from the late 1960s, and it's the optimal path to the truth. And so we're kind of for geeks by geeks, and so we're looking for just the innovation economy. I'll say not just Silicon Valley, but all around the world. We did incorporate in the Caymans. Another factoid, when you do that versus incorporating in the US, you can find partners all around the world. So we've been speaking to potential partners in South America, in Europe, and otherwise. And you'll hear that I use the term partner instead of target, because it just sounds like we're trying to assassinate somebody. So we're trying to improve the lexicon, the language of the SPAC is another mission we have.
So, John, you recently acquired CuriosityStream. Can you talk a little about what the company does and sort of what's your role now that you've de-SPACed? Are you sort of on the board, or how does that work?
Sure. So CuriosityStream is a leading streaming factual media company. So think about Netflix for documentaries. It was founded by John Hendricks, who founded Discovery Channel, Discovery Network. He ran it for 20 some odd years, put 150 million of his own money into it to get it started, and brought in some other partners with him. They were looking to go public, and we found each other and ended up doing the de-SPACing together. It was about a a 5-month process when it's all said and done. And now I've moved from being the CEO of my initial SPAC to being a board member and head of audit committee and being a few other committees of Curiosity Stream, and given my background running companies, and having been in the streaming media, trying to help out where I can. But it's not my day job. My day job is looking for the second target.
And SPACs are sort of interesting. It's sort of a combination of search fund, M&A, and IPO. It's sort of this sort of combination. What's the typical structure of the sponsor management team? And then in terms of like, what's the bare minimum team you would need to start a SPAC?
Well, I could talk about mine. There's 2 of us. There's 3 sponsors, and the sponsors put up all the cash to get it started, and it's 3% plus a little bit more of how much you want to raise. And you can bring in partners. Stuff. It's just 3 of us. We're all friends. 2 of the 3 are the operators, myself and Mike Nixad, who's been with me for the better part of 20 years, helping me run companies. And that's it. You could have a 1-person team, and I've seen 8 or 10-person teams. It really comes down to deal flow. You find it's what you're really doing is taking a company public and in another means, and you have to find the deals, win the deal versus some other SPAC, because there's no such thing in my mind as a proprietary deal. I find deals, they're going to go talk to somebody else, and all the deals I see, I know there's another SPAC in there and other folks that are looking at it. So you have to convince them to go with you versus someone else, and then see the deal through to fruition. And then the management team runs it just like any other IPO.
And then Jamie and Kevin, the structure of your groups.
Yeah, sure. So the first SPAC we did was a little bit different in that we intended to likely take a stake in one of the larger cannabis platforms. And as we got inside them, what we realized is that there were a couple of smart folks at the top that had bought a bunch of licenses that had very little in the way of operations or operational HR and infrastructure and talent, but yet the valuation started ballooning towards $1 billion. And so as opposed to buying a 20 or 30% stake in one of the larger platforms, we effectively decided to build our own. And so we went and bought 5 simultaneous companies that formed the nucleus of the SPAC, and basically did a roll up the old fashioned way by buying profitable businesses that had great local talent, but there wasn't necessarily a CEO or a corporate infrastructure team. And so unlike the typical SPAC structure where you might be chairman or have a couple board seats, in this particular situation, we inserted a completely new corporate team on top of the operating subsidiaries, which started out as maybe 5 or 6 people, and now we're up to 20 or 25 people at the corporate level. So that was a little bit unique in terms of that first SPAC. The second one, especially given that we already have a platform that we're operating in the space, it'll be focused on brands as opposed to infrastructure where we're doing cultivation, extraction, and retail. And that one will be more traditional where we're looking to put together probably 2 or maybe 3 brands together, and we'll take a couple seats on the board, and in most cases think that there's the public company CEO embedded in one of the companies that we're likely to partner with.
That's pretty interesting to do, like multiple acquisitions under one SPAC. Are they buying separate legal entities?
Yes. Yeah, they're totally independent groups. High degree of difficulty, herding all the cats, and each of them having independent financial advisors and lawyers and everything else, and having them have to underwrite each other as well as the SPAC itself. So it's not for the faint of heart, but particularly in industries where I think there's a bit more of a platform multiple. I think that the smaller companies can see the vision of teaming up together and having something that's ultimately worth more than what their individual exit might be in a traditional scenario. And companies that probably don't have the scale to go public by themselves, which is a little bit different than some of the other things that we typically see in SPACs.
And then Kevin, you mentioned you had 4 people on the team.
Well, I first wanted to ask Jamie, that's quite a degree of difficulty, Matt, that you pointed out. Jamie, did you consummate all the acquisitions and the de-SPACing at the same time? Meaning,
yeah.
Or yeah, that's incredible.
Yeah, so we basically had to sign 5 term sheets and have a prospectus that had the disclosure for the consolidated business, and then keep all the pieces together during the 4 or 5 month period, especially given that there were some regulatory approvals that extended the closing process a bit.
That's really impressive, because the kind of state of the art for that now has been, I forgot the name of the real estate tech SPAC that acquired Porch. So they acquired one as kind of a central piece, and then they'll roll up from there. But to actually do that many at once is
there's only a couple. There have been a few that have done 2. So a SPAC has funded a merger or something like that I've seen. There's maybe 1 or 2 out. There was one in the software space a few years ago.
Yeah, the government roll up. That was a really complex.
Yeah, the problem is I think they put together a bunch of somewhat unrelated, less high profile companies and kind of mushed them all together without necessarily an incredibly cohesive strategy. So I think it works in some areas, and I think it's more challenging in others. I don't recommend 5. I wouldn't do that again. But I think 2 or 3 can be interesting if you're investing in an industry that has a lot of consolidation opportunities.
And by the way, that one was GTY.
Yeah, that's right. That was
and it was run by Joe Tucci.
Yeah,
my boss at EMC. He's one of the most respected CEOs of a big company ever, and just shows you the difference between running a SPAC and running a $20 billion enterprise. It was a cluster.
Yeah.
And also
the other thing I would say on that one, right, like incredible amounts of talent, and some of those folks coming out of Accenture and other, I mean, their resumes were spectacular. You have to thread the needle of deal flow and deal expertise and hustle, with great operating talent or people that have unique vision in the sector. So I've seen people that have been great investors, great operators. Some are great at SPACs, some are terrible at SPACs. And it's a bit of a unique structure for sure.
I assume you were doing a PIPE at the same time as well, Jamie?
We did not do a PIPE.
Oh, you did not do a PIPE.
We didn't. And fortunately, the market was pretty hot back then, and multiples were expanding as we did it. So the stock popped right away. And quite frankly, I think some of the underlying businesses, weren't necessarily as sophisticated, and I'm sure we'll get to it in this conversation, but didn't realize the risk of redemptions, and so therefore didn't realize that they were maybe taking a little bit of that uncertain execution, which turned out not to be the case. We didn't have any redemptions, but that's obviously one of the flaws of the SPAC structure that I'm sure we'll get to in a bit.
Mm-hmm.
Yeah, no, that's great.
Matt, I see there was a question from Wendy Richards for Jamie about the companies. I don't know if you want to.
Yeah, sure. Jamie had a question like, with 5 companies merging, is it a holding company? Or do you then spin off each company separately?
No, we basically made 5 simultaneous acquisitions that flow up through one holding company that we've now fully integrated.
I mean, what's interesting about doing those multiple companies at a time, you're sort of creating more targets, because there aren't that many unicorns available, right? Pre-IPO unicorns. So if you can take some smaller ones, you're really adding to the universe, but it's definitely more complex. So,
right, and particularly in this industry, let's just say generically, you could buy individual state operators at 4 times EBITDA, but the public platforms trade at 10. You can really articulate the instant synergies to the operators of why it's more beneficial to join a larger platform than to try to go at it alone.
Yeah. We got a question from Professor George Foster.
Oh, long time.
So he covers the sports industry, and he has a question: Are there SPACs that focus on sports?
There are actually, yeah,
35. The answer. And actually, I'm looking at that as well. And I think that what's interesting about sports is there's 2 types. There's sports technology, and a lot of what you see here, like gaming technology, esports. But then there's buying the Boston Red Sox, which is supposedly what Redbird, Billy Bean's SPAC's going to buy a chunk of the Red Sox and take them public. This is an interesting space. There's a lot of money tied up in sports franchises that could go public. That could, you look at Jerry Jones as an example. I doubt he's going to do a SPAC, but he's got billions of dollars tied up in the Cowboys. If he took a public, he'd take a chunk out if he so chose. And they would, the problem is the NFL, would they let you? But assuming that were the case, some leagues will let you, some won't. It's certainly an interesting space. And Professor, I'd be happy to chat with you offline if you want to speak about it.
I think Magic Johnson and the former head of TikTok just launched a SPAC for
They
sports.
did, and Shaq just launched one with a friend of mine, Salil Mehta from Fox Sports and ESPN. And yeah, a lot of what a SPAC's about is finding deal flow. And people, it was actually yesterday, I was on a call with somebody who was dismissing why the hell would Shaq be able to raise money. It's because people like athletes, and people want to be in a room with the guy, and you want to show him your deal just because he's Shaq, just because Magic Johnson's Magic. And so are they good business people? I don't know. He may be a great business person, but people are going to want to talk to him just because who he is.
Right. Well, DraftKings is an example of one that actually has gone forward. It's a pretty complicated transaction.
Done super well.
Yep.
And actually, that was done by Harry Yu, I believe, wasn't it?
It's one of my partners has worked in that one. So again, Professor Foster, if you're really interested, I can certainly set you up with my partner who worked on that deal.
Okay, great. So that leads, I mean, I've been doing some research. There are something like 200 active SPACs across lots of industries. A lot of them don't really say what their focus is. They're sort of generalists to be more flexible. But it definitely seems like the focus is on tech, high growth areas. There aren't many SPACs that are just sort of focused on low growth sectors. Is that just because of the valuation arbitrage?
I mean, I guess I can just point out one legal aspect and that we've talked about internally is when we look at those industries, they do tend to be sort of high growth and often sort of pre-revenue companies. And at least from a legal perspective, one of the things we think helps that is that, in an IPO process, you can't provide projections, but during the SPAC process, you can provide projections, which allows entities to perhaps provide more granular information about growth strategies and the hockey stick effect that might be more appealing to investors. And that's sort of me talking as a lawyer. I'm sure there are other more important reasons, but that's one thing we've noticed in terms of our practice and the types of companies that are going through the de-SPAC process.
And it's what the market wants. We're just providing access to the public market. If you look at the energy SPACs, if you look at all the SPACs that failed over the last 3 years, I believe all but one are in the energy sector. One was in retail. So you can understand why those companies the public market are not desirous of buying into those stocks. Cannabis is huge. People are excited about it. And what Jamie's doing makes a ton of sense. Software, high growth software, there's a dearth of it, frankly, in the public markets because private equity has bought it all up, and now private equity is seeing a chance to take it out. But there's a lot of other SPACs, non-US companies that want to have access to US markets, but you've got to have a story to get the public market's interests. And if you get Robinhood behind you, then you can do even better. There's I can tell you, enterprise electric vehicles is the hottest thing in SPACs these days. I've looked at a half dozen of them. I wouldn't touch them at all, but I'm wrong. Our friends at Force just did $2.5 billion deal with a LiDAR company, one of a dozen. It seems to be working out so far.
Right.
The other thing, going back to the valuation point, is if you're operating in a very mature industry with tight boundaries on valuation multiples, let's say in industrial distribution where all the comps trade about 9 times, it's really hard to get something dramatically off market. And when you layer in the management promote and the warrant overhang, and if there's not a lot of growth in the business or some unique aspect to the story, it's really hard to get investors excited about that, particularly if they have other similar opportunities in the public markets. So I think that lends itself well to growth, things that are maybe a little bit more, speculative or further off, space, the Virgin space deal, electric vehicles, some of the earlier stage software or tech companies that investors haven't had access to in the last several years because of both private equity and because many of them have just waited until they're much further along in terms of the maturity curve. And so it tends to work best in industries that have less functioning forms of capital, or some uniqueness to their growth curve that's just not a steady Eddie business.
I think the largest SPAC ever was this Gore SPAC that bought a mortgage company. I think it's like a $13 billion SPAC. So that's a less tech type of industry.
And it's actually not doing well at the moment.
Yeah.
So is there a SPAC bubble? I mean, there's just, are there enough companies out there to find?
Yes. There's no bubble and there's tons of companies. That's my preference. But I'll tell you, I'll give 10 seconds and I'll let the other guys talk. There's, let's call it 200 SPACs. There's 8,000 PE firms. And so while Kevin and I may be looking at the same deal, I'm looking at 6 or 8 at a time. I'm sure he'll be doing the same. And, we only can do one. What Jamie did is unusual. And I wouldn't, try to do that in the tech space. Certainly not 6, maybe 2. There's a shortage of people, Kevin and me, relative to the opportunities. I'm seeing inbound, at least 1, if not 2 a day. Inbound opportunities. And again, you do 1 and then move on to your next SPAC.
I would maybe comment that there's the potential for this to look like, are we in 1999 right now? And we probably are going to approach that. There are a lot of opportunities, and Jonathan made a great point, of how many PE firms there are, or just how many private growth venture funds there are, and how many deals they do a year. The number of SPACs still is a small size. I think there's just a potential. There's a kind of perverse incentive to go after companies that are more likely to have a bad outcome. So if you have a company that has no revenue till many years in the future, and it's going to be successfully received at some point, that company has to perform. And so if we continue to see a lot of those versus the strong fundamentals, that's problematic. So if you maybe describe it like 1999 and 2000, you see a lot of companies that were not very strong. They were weak, the pets.com and so on, they collapsed. But then out of that came the Netflix and Googles and PayPals and so on of the world that slowly emerged from that. And I would guess that SPACs look very much the same, that you have the kind of high flyers that go after these very sexy electric vehicles or space travel. And then you have people that work hard to find really enduring businesses that with really great leadership teams, and those will be the long-term winners.
Yeah, I agree that there's going to be, I'd say 90% of the EV deals are going to fail. But, that's the public market's job, frankly. That will it tarnish the SPAC world 3, 4, 5 years now? Probably, and everything's cyclical. As I said earlier, most of these deals I would not touch. I'm sure Kevin wasn't touching them either for the reasons he just mentioned. But, the public market's excited about Virgin Galactic. They're 1 engine failure away from being a 0, but they're trading at a multi-billion-dollar valuation. That's what the public chooses to invest in these days.
Yeah, well, my son and all of his friends are so excited about electric vehicles. They're all buying into these electric vehicle deals, which to me is a sign of a market top, right?
Yeah, one interesting thing that I've seen even in the cannabis space, which again has some unique aspects of why they shouldn't be competing with 50 other opportunities. I think 2 of the cannabis SPACs in the last 3 months ended up doing non-cannabis deals. And I think it just goes to show, like, this is hard. It's not so easy to put these deals together. People do face, the ticking, clock. And I think there's a massively wide dispersion amongst the talent and deal flow of the sponsor group. And I think the hurdles to raising the SPAC capital have gotten too low. And by the way, the last time around why SPACs got a reputation is because C-grade sponsors did D quality deals and the outcomes were very poor. And then that painted all SPACs with this negative taint. And that just reversed itself over the last couple of years because there have been a number of, good deals and good outcomes. But I think there is a risk that I'm starting, there's some great folks that have raised capital. Have your opinion on Bill Ackman and others, but the super high profile folks are raising capital through these vehicles. But then I see, an SPAC IPO a day coming through some of the lower quality banks and sponsors with terms that get deals done. And I'm not so sure that there's enough great deal flow that's going to result in great outcomes across the board. But I think there'll be a massive dispersion between the kind of tier, 1 and 2 sponsors and everybody else.
And I agree. It's no different than private equity or venture capital. It's the same. There's always better people doing it. And frankly, one thing I disagree is I don't think there's a high correlation between someone's pedigree in their previous job that's non-SPAC related and how well they do SPACs, other than the fact that someone like Bill Ackman gets a lot of press. And I can't speak to Bill personally, but you look at Joe Tucci, the guy was an incredible CEO, but the running a $20 billion business and running a SPAC are 100% different. And I do agree there's a lot of lower quality guys that have, or lower quality teams that have raised money, but that over the last, few weeks, and hopefully it'll continue to go on in perpetuity, the banks have tightened up in the SPAC mafia. That's the people who put money into the IPOs. They've become more judicious just because they put so much money out. They don't have that much left at the moment.
One thing when I talk to some entrepreneurs, they're sort of thinking the SPAC is like some much faster way to go public. But fundamentally, you still have to be ready to go public. You still need SOX compliance. You still need financials. I mean, how much faster is it to do a SPAC IPO for the target than it is a normal IPO?
Hugely fast, much, much, much faster. And I ran a public company 15 years ago, and it was very difficult relative to today, given all that you can outsource now. You have all these startups effectively outsourcing most of their public company requirements. And if you're small, there's not that much SOX compliance. If you're big, sprawling industrial, it's hard. If you got 60 people, there isn't that much. But but to what Warren said earlier, you get out, it's 4 or 5 months, maybe 6 on the back end, versus it could be a year and a half with no guarantee that you're going to get out if you go through the standard IPO process when you're just getting started.
Right. I mean, that's exactly right. When we market, we tell people, well, of course, everybody wants to be aggressive. We say you could do it in 3 months, but we say it's a 3 to 6 month process. And as Jonathan said, an IPO, we always tell people at least 9 months, and it could be significantly longer. So it is going to be a little faster. It's not clear that it's cheaper because you've got the SPAC IPO, then you've got the merger, then you've got the PIPE, and then you've got the proxy process for getting the de-SPAC. So it's not clear to us that it's cheaper, but you can certainly get it done in a little bit of shorter time frame.
Let's see. Can you talk a little bit more, Warren? I got some other slides about sort of the advantages to the sponsor. I mean, I think that's particularly interesting.
Okay, let's see. Are we getting the slide up?
I mean, advance or not, I can't. It's hard for me to see it.
Yeah, I'm trying to find.
I'd love to hear everyone's opinion on the sponsor promote and where it goes.
That's one of the reasons you want to do it, right? for sponsoring this back. Sorry,
I'll say out loud, it's just too high. If we want to continue to bring SPACs into the mainstream, the promote needs to come down and be more in line. It doesn't have to be at 7.5%, the traditional IPO route, or whatever the banks are charging for a direct listing, but it's got to be, there has to be some price compression or an Amazonification of the SPAC. It also will do well if we see that in kind of warding away kind of the faint of heart or those that are just out to make a quick buck. So I just personally, I see the SPAC fees coming down as we see others lowering. It just gets negotiated down.
And
I would disagree with that. I think when you look at it, it depends how big the deal you're doing. Like Kevin and I have roughly the same size fund, and you end up with 20% net post money of that size fund. But if you're doing $1.5 billion deal, it's a very small percentage of the actual deal value. And what I've done, and Kevin may be doing the same thing, is I structure my promote. I don't give it back, but I say, look, I'm going to earn it back. It's 100% vested day one. I say, look, I'm going to vest. I'll keep some of it, and the rest I'll vest at higher numbers. So I'm playing along, and I don't earn my vesting back until the stock price goes up. So if it goes down, I've lost it. But I know when people, and the first thing bankers and lawyers tell me is, oh, you need to give up some of your promote. My answer is, why are you stealing for my children? It's frankly 1 or 2%. That it's not gonna make any difference. This is why it's a business. This is why we're here. Now, to Kevin's point, if you're doing $1 billion fund like Ackman, you can afford to give away a lot more. If you're doing funds our size, it's really not relevant in the
Ackman
overall.
doesn't give away that much. If you read the documents, he ends up with something like 6% of the
Right. And
the
he could, but he chooses not to.
deal. It's it's a very aggressive, different type of promote. But what I'm hearing is, I don't hear this from the bankers, and we wanted to actually come out with a lower promote, and the bankers told us to keep it high and just, if you have to negotiate it down. And same with the lawyers. We're hearing it from, just there's some amount of really high quality companies, and they understand that the cost of capital is very important to them. I understand, having the experiences at Eventbrite that we went through, we just went through a painful exercise in dilution where we had to do an emergency fundraise for COVID and a public convert, and every penny made a big difference in terms of reducing the cost of capital and the dilution. When you look at like the promote size and you equate it out to, it could be 100 engineers that are on your team. And so there are some pretty sophisticated founders out there that understand this. Some don't, some are sophisticated and just want to get a deal done. The raise, getting out in the public markets, deal certainty, that's what they look for. But there is a group that's focused on the sponsor itself, and I think it'll compress over time.
And I do agree about the sponsor makes a big difference, because they're going to be living with that person or that group for a while. And the question is, what value are they going to add? What does it be like to work with them? No different than dealing with a PE firm. The difference being PE owns you. We don't own them. We're just advisors, and we have a piece, and we're just the activist investors that hopefully are very positive.
John, can you talk to what the roadshow was like during COVID for Curiosity Stream?
It was actually easy because it was all Zoom. When I did my first IPO roadshow, it was in the real world, and I was driving around and flying around, going to see everybody between New York and Toronto. But the de-SPACing came around during Zoom days, and we were doing about 10 Zooms a day. We do a pipe roadshow to do the pipe, if assuming you do one, which most do. And then you do come back, after the pipe, 2 months later, when you're ready to go to do the combination of the de-SPACing, another one. And so it's maybe a week each of 5 to 10 a day. But given it's Zoom, it's actually relatively easy, and painful for management, but it's our job.
One thing I'd add is you could also say that the kind of tidal wave of the SPACs was encouraged, or there was some strong tailwinds of COVID. And just as Jonathan said, all of a sudden we moved to Zoom. So that barrier of having to travel around the country of a traditional public offering, disappeared, and could be all done via Zoom, or DocuSign and HelloSign. The myriad of documentation between banks and lawyers and the sponsors themselves is staggering. And so we kind of had these sort of advancements come into place. It's kind of like broadband and YouTube. Why does one thing take off at a certain time? And I would conjecture that SPACs had this real strong tailwind from COVID because we moved digital.
I agree.
Could you talk to, like, as an individual investor? I mean, you can play in this space. You can buy the SPAC itself, and then you can choose if you want to participate in the de-SPACed entity. I mean, there's some interesting things with the warrants that come with buying the SPAC. Can you guys talk to like some strategies for individuals?
We'll let
Sure,
Warren do that one.
I can do that. So I ran a SPAC fund before being a sponsor. And one of the things that's really attractive for public market investors, whether it's institutional or personal investors, is effectively, given that all the cash is held in trust, if you're buying the unit at or around the IPO, there's literally no downside. You're backstopped with a redemption right with cash and trust that's growing. Well, interest rates used to be positive, but effectively you get a free look at the deal with typically between a quarter and a half of a warrant that's usually struck at $11.50. And so if you built a portfolio of high quality sponsors and you simply held them until a deal is done on an unlevered basis, you have a reasonable shot at earning double-digit returns. And so for a hedge fund or someone else that may lever that or compare that to risk arbitrage or convert arbitrage or merger arbitrage, I just haven't seen a better risk reward in my career if you can navigate and choose them wisely. But even if you don't, it's still going to be okay. And so if I had excess cash that I didn't want to deploy in the market because I thought it was overvalued or I was uncertain about the trajectory, it's a much better place to park cash than any other form of cash substitute. And I think that's one of the reasons why there's been a lot of demand for people investing in the front ends of the SPACs themselves.
So is that true? As long, because they typically trade around $10 a share, but then they trade even more before the de-SPACing up and around that.
Yeah, so there's a couple strategies that people have. So if you buy the unit at $10 a share in the IPO, it consists of one share of the common stock, and then let's just say it has a half of a warrant, and the warrant coverage changes by SPAC. But that common share is going to be worth $10 plus interest at the time of the deal. If you redeem, it could be worth $12 or $15 or $20 a share if it's a hot deal. And then the warrant, even if a deal gets done and trades at about 10, they usually are worth about $1.50 or $2 a share. And so if you get a half of a warrant, let's call it 75 cents to $1. So if a deal simply gets done and it just trades at parity, your $10 changes to, is worth 11. And if it trades up, you're getting leverage on the warrant as well. And it can be worth, 20, 30, 40% more pretty quickly. And so there are those that simply trade in the warrants, higher risk, higher reward strategy. But if you picked a basket of warrants with good sponsors that get deals done, number one, and number two, some portion of them trade well, I mean, that can be a strategy that returns 30, 40, 50% a year if you pick them right. And if you take the lower risk strategy of just holding onto the common stock and you're buying it at $9.70 and your downside is you redeem it at $10.07 and some of the deals turn out to be pretty good, it could be anywhere from a low to mid single digit annualized return to something into the double digits. And so I think there's a risk reward spectrum that fits for many different types of investors that are running different SPAC related strategies.
Interesting. Is there a SPAC ETF?
No, I was just going to mention, Jamie.
I think
made a point.
I think one just started. I don't know how it's done, but most of there aren't too many retail ways to play a basket or to have a liquid ETF format unless this one recently got some traction. And there's a couple hundred of them, and just tracking down the ticker symbols and everything else is a bit of a challenge. There are a few websites now that have some are free, some are subscription that put these all together. But many of them are available in any traditional brokerage account.
I wanted to make one point and actually a question for some of the others. One of the things Jamie mentioned, which I wanted to highlight, is you actually essentially have a put option because you have an ability at the time of the de-SPAC to redeem your shares. So you can even take a look at the deal at the time and decide whether you want to have a redemption. But the question I had was, that there is trading on all of these the SPACs, and based on what I've been seeing or reading about lately, it sounds like some of them are actually trading below their IPO price. And I'm curious whether, other people here are seeing that and whether they think there's an opportunity. I just saw a chart and just eyeballing it. It looks like, 10, 15% of some of the more recent IPOs that don't have announced targets are actually trading below the $10 a share. And curious what others think about that and why that might be the case.
Yeah, well, my 2 cents is, one is the market. And if you look at Churchill 4, whatever the current Churchill one is, that Michael Klein, probably the best SPACer out there.
Mm-hmm.
In March, it was trading at 950. And it was because the market was off. It's like, I tried to buy it and my broker wouldn't let me. And are you kidding me? Anyway, and then it ended up, last I checked, that particular one was like 1150. So there's times when everything sells off. But really what it is, it's a measure of what does the market think about your ability to get a deal done. And usually what happens, there's the units to start with, and then often they get separated between a unit is a share with some portion of a warrant. Like in our case, it's 1 share and half a warrant. And once we separate the two, the warrants is just a question, are you going to get a deal done? If you get a deal done, the warrants will have value. How much value depends on how good a deal it is. And then the stock itself, to your point, you have a put option. If you're buying it below 10, if it's at 950, at least however long's left in the stock, you can get to $10 back. But that's usually, and if someone's towards the end of their life, it's going to trade differently too, because usually you have 2 years to get a deal done before you have to, liquidate and give the shareholders their money back.
We've got a couple of questions from the audience. The first one is, what are some of the tax advantages of a SPAC over a traditional IPO for the different participants? I'm not sure who's best able to answer that.
I'm not aware of any, Warren, are there?
I'm not, but I confess that I'm not a tax lawyer, and I sort of let our tax folks do their thing. But it's you've got an IPO, and the other transaction, it's sort of a merger into an IPO. So nothing off the top of my head, but I can certainly check with our tax people and see if there's anything meaningful there.
My non-educated side would try to give advice, would just say they're both cap gains, so there just wouldn't be a difference.
That's my understanding.
Then David's got a question. Is the minimum size SPAC determined by the public market float, the enterprise value of the intended de-SPAC, or the percentage of the enterprise sold? So how do you sort of set this minimum size of a SPAC?
But I think what you typically do as a sponsor, right, is you look at the opportunity set of your strategy, right? So in the case of software, you might say, hey, the sweet spot are companies trading, worth $750 million to $1 billion of enterprise value. And if you're solving for the SPAC, you want the target being, let's say, 3 to 4 times bigger than the SPAC. $200 million seems like a good size. If you're going, whale hunting for unicorns, like I guess Bill Ackman is, maybe it's more appropriate to do, $1 billion SPAC. But again, the larger you go, the less flexibility you have. I mean, you could do a $20 billion enterprise value company with a $200 million SPAC. You can't do a $800 million enterprise value company with a $1 billion SPAC. So through pipes and other things, or owning a smaller portion of the overall enterprise, it's really just a matter of how much cash that the company actually needs for either growth or for secondary sales. So I would advise people generally to be smaller on the margin rather than bigger. But there's probably a size where if you're below $150 million, and that ultimately is going to be tethered to the float of the company on the back end, public market investors don't want something that's too illiquid, and you do have to be able to deliver some reasonable amount of cash to the prospective target.
I mean, it does seem like there is some role for a smaller SPAC. I mean, there's a lot of these lower middle market companies. Now, I know the economics favor being bigger, but it seems like there's some underserved.
Well, I think Kevin and I have basically the same strategy. Start smaller gives you more opportunity, because we can both go big, but the big guys can't go. So there's two actually issues with the minimum size. Maximum, really, as Jamie said, maximum really comes down to how much cash they want delivered and what the economics are of getting there. The minimum, there's a legal requirement, which I don't think really comes into play. It has to be at least 80% of your SPAC cash. Warren, is that correct?
I think that's right.
Yeah, but that doesn't come into play. The reality is you have to do something significantly bigger than what you're doing. Whereas Kevin pointed out, the dilution that you inject between the warrants and the carry to promote, it just overwhelms the deal value. So you have to have something on the order of magnitude, what Jamie and Kevin said, multiples of the size that you've raised, so your dilution you're injecting is minimized.
The other thing, Matt, going to your question on the small size, like from an opportunity set, you might be right. The last 5 years, the market has no bid for $200 million market cap companies. It's got to be the most unique opportunity in the world. If you show up with a $50 million SPAC to go after a $200 million company, I can't think of any SPACs that have been, I'm sure I'm off by one or two, but it's littered with failure. And you announce a deal and it's a big thud, nobody cares, nobody looks, and hedge funds and institutional investors just don't have any interest in looking at illiquid small cap companies, and the actively managed universe continues to shrink. And so it's just not what the market wants. And so the degree of difficulty is substantially higher, even though there is a capital markets hole for that opportunity set. I'm just not sure that SPACs are the best equipped to take advantage of those opportunities.
I don't think there's any market for a $200 million public company, IPO or SPAC, period. Fidelity and the rest just don't care. And the little guys, it's too small a check for them to make sense.
A lot of you, the panelists, have worked in private equity or venture. Like to the sponsor, it seemed like SPACs are very attractive. I mean, in terms of the timing to liquidity, the promote. Sort of, how does being a SPAC manager compare to being a private equity manager or a venture manager?
Well, it's very similar that you're in both cases out looking for companies. I spent a little time on the venture side, and you in both cases you're looking for enduring companies that you can be an investor in for the longest time. This is a one-off transaction, so rather than building a portfolio where you're hedged, it all comes down to one. And I guess we all are risk-seeking in that case, where you de-SPAC with a company and it trades, and you hope it just continues to grow over the long term. So that's, I think, a very important aspect. You're seeing a lot of venture funds actually getting into the SPAC world. So Mickey Malka, for example, at Ribbit Capital, which has been an incredibly great investor in the fintech side, is now moving on that. And you could argue that venture may be a natural extension, or that SPACs may be a natural extension to venture capital as well. But they're very similar, and there's and then the other side is you're not out knocking on doors of LPs for months and months and months, trying to get your institutional venture investors on the back end. Instead, you have a one-day roadshow, and you have your 200 million to go out there. So there's quite. I could probably go on for a while. I'll let Jonathan or Jamie or Warren talk, but it's an interesting question to ask.
Yeah, it's a one-off private equity deal where you don't have to Kevin's point, it took me 5 days to raise $200 million. It's like, it's so much easier. It's a small, you don't have to build out a business the way Gores and Platinum, you have lots of employees, you have a real business, you have to do lots of deals, and you have to deal with lots of LPs. Here it's us. Now the risk is we all put up money. Now, if you're doing a $200 million deal, you're putting up $6 million of your own money. And if you don't get a deal done, you lose it, period, end of story. So to what Kevin said earlier, that a lot of folks who don't have good deal flow at the end of it get desperate and do bad deals just so they don't lose everything, and they lose most of it, or they keep it but they have a crappy deal, and that's going to happen. There's no doubt that a year from now there's going to be people like that. That's so it goes. But for me, someone coming out of private equity and venture capital and a CEO, this is a great way to run a one-off private equity deal.
A question from Rashawn. What happens to the sponsor equity if a deal isn't done? I guess you said it just goes to zero?
Lose it all.
Yeah.
Well, at-risk capital for a reason.
Is that because you spend it on legal fees or things like,
No. That's why IPO guys are excited that when we talk about redemptions, your money goes in to pay all the fees in the end, plus the redemption. So, and that frankly also keeps the sponsor community a little bit better off because one, we don't get paid, and two, you have to have enough money to actually be able to lose a few $1 million and not have your wife shoot you.
Yeah, the only kind of downside to that is that there's now a lot of SPACs that others are buying the at-risk capital in exchange for ownership in the entity. So you're seeing that happen, which lowers the barriers to even more entering. But yeah, I think it was an important thing to put, my own money to work here and take that. It seems like the rite of passage, but you could see many more SPACs coming out if this kind of trend continues where other people are fronting. I just heard Blackstone had fronted and bought a certain amount of the at-risk capital for a certain percentage ownership.
And I do it for my friends because I want to be in more SPACs, but it's only sponsors that are putting money in. I give advice and I can help out. But to what Kevin says, if the operators aren't putting in significant skin in the game, I think it will lead to misalignment. One other thing on the VCs, I think that's a short-lived phenomenon of VCs and PE guys getting into the SPAC game. The reason I think their LPs are going to be pissed at them, because you look at TPG, they're already getting some blowback because the LPs like, all right, so you're doing this and you're spending your time on that where you're going to make more money personally, not giving us, and we're paying all your expenses. That's not right. And so we'll see if a year or two from now, they're still excited about it because their bread is buttered on the other side of the equation. A one-off SPAC, while it may make, Kevin and Jamie and it'll make a difference in our net worth, it's not making a difference in net worth of Ribbit Capital.
Just going back to the fees for a minute and going to Kevin's point about, potentially it being, too rich. There's obviously some real risk that sponsors are taking, right? But let's say a $200 million SPAC, generically, the sponsor at risk capital is 3%. So the sponsors put up, $6 million. And in return, they're getting either warrants or some units in addition to the 20% promote. So they're going to end up, if they don't have to horse trade or give up the promote, with $50 million of stock on the back end, plus some value of whatever they got for the warrants or units that they bought. So in a 2-year period of time, to potentially make 7-8 times your money, it's really hard to do that as a venture or private equity sponsor. And so if you get it right, this can be probably the most lucrative way to earn, I'll call it carry, but it's not even really carry, earn economics as a sponsor. And I think that goes to, is the alignment between investors and the companies and the sponsors dialed in appropriately? I think it probably needs some tweaks. I also think there need to be some tweaks on the structure to reduce the uncertainty of how much cash is going to be there in trust. And so there's been some creative tweaks, particularly in the last 12 or 18 months, where perhaps you get a little bit of warrant coverage up front, but the investors that don't redeem, maybe get some extra, on the back end. I think there's going to be some continued tweaks to the structure to make it better for everyone, because as a sponsor, if you could walk to the table with much more certainty on being able to deliver that cash, your ability to get access to better deals and to negotiate better, which ultimately will help the public investors, is far superior.
Any other questions from the audience? You can just add them to the Q&A section. Let's give it a second. Okay, well, I think this has been a been a fascinating panel. It's been great to hear from 4 experts in the space. Any closing thoughts on the SPAC space?
Are you asking me? Sorry, Matt. I wasn't sure you asked.
Just in
Yeah.
general,
I mean, my closing thoughts again. We continue to see a lot of activity. I think that that I guess there's been a little bit of a slowdown in terms of just sort of new flow activity. And as I mentioned at the beginning, I'm just curious what's going to happen with all of the SPACs that are out there. And there's all this activity and interest, but will there be sufficient deals? It sounds like Jonathan's pretty confident that there will be sufficient deals, but we'll see in 2 years that whether all of these companies can find their targets. But it's certainly been interesting for me because these deals SPACs were not really a favored vehicle a number of years ago, but that seems to be have changed pretty dramatically, and you've seen some pretty interesting stories like the Virgin story and the DraftKings story. So I think it's here to stay, and we're excited to be part of that process.
Yep, I agree. And we're the flavor of the moment, and that will change. But for the foreseeable future, there's going to be a bunch of SPAC deals done. And just one sales pitch. Anyone has any ideas? Feel free to reach out to me.
I may have some. I may have some for you, Jonathan.
Thank you. I appreciate it.
To kind of close, I do think this is a phenomenon with some staying power. It's kind of like Bitcoin or the internet, which kicked around for a long time and then finally took off once it kind of hit this kind of critical point. And so it feels like this kind of financial vehicle is all of a sudden hitting this like inflection curve of a technology business. So I think it's here to stay as a new mechanism to get out into the public markets beyond direct listings and beyond the traditional IPO. I think it'll make Bill Gurley and all his complaints about the traditional IPO even happier. And I think it's here. Hope it's here for the long term. And has a few reforms, but really excited to see how this plays out.
Great. Jamie, or now we can wrap up. Great.
We covered a lot.
Thank you so much. I learned a lot, and hope the audience did as well. Thanks for everyone for joining the Stanford Angels of SoCal event. Go Stanford.
Great. Thank you.
Thanks, Matt.
Thanks for having us.